today I would like to talk about how these companies are actually collect their shareholders' equity, because we can see here highly mixed strategies, and that's why today we will start this topic, and next week also I collected some data about already public listed companies in this sector, so we can analyze their share prices, how they are working, what kind of anomalies can we identify, what is happening with their share price when their vehicle explodes, and so we will analyzing stuff like this, or what is happening when some kind of announcement is made. Is the market reacting on it, or it's already priced in because of insider rumors? So if you are looking on the balance sheet, then today we will mostly talk about only about shareholders' equity and not other kind of liabilities or elements. So if you have to think about sources of the equity, we have to say that, okay, founder has to put in some kind of money. So let's say in the case of SpaceX, when Musk started it, then he invested half of its earnings, what he got after selling his shares in PayPal, and this is the initial investment. And the next thing can be the so-called private investors, and it can be so many things, because actually private investor can be a specialized investment enterprise, or it can be a mutual fund, or it can be even we will see that some pension funds can appear here, or some undisclosed investor, what we can also find here, or other specialized. But even if we are talking about private investors, there are special categories. So angel investors, venture capitalists are highly specialized on not just on startups, but on companies with huge growth potential. So it can be a reorganization of an already existing company. And also we have to talk about special purpose acquisition companies, SPACs, which can be also significant for us, and obviously public listing, which can be important, because some or SPACs are always used to enhance or to support IPO procedures, and that's why we have to talk about them, because we can see that they are highly popular nowadays, and that's why we have to talk about them. And also there can be special ways for equity financing. One is seeding capital, and the other is sovereign wealth funds, which are state-owned investment companies. And first we will define all these categories, and then we will see that how these kind of funds are used in the case of Rocket Lab, and also in the case of SpaceX, because I was able to dig up these informations from Reuters database. So venture capital, it's quite important, because if you are looking on the market since 2017, it was exploding. So only in the US market we can see that it's highly relevant, and what we can see here, that mostly not just early stage venture capital investments are significant, so focusing on startups. The most of the money is invested in later stage companies, when they are already growing, but they are still in the stage of expansion, so that's why they need for further asset acquisitions to finance their expansion, they need huge amount of investments, and that's why they need capital. Or also we can say that in many cases, if you are purchasing an old and already existing company, if you are selling or liquidating the assets which are still making some profit for you, or some segments in the company or divisions in the company which are maybe not contributing too much for value generation or cash flow generation. So are you removing them, and in this case you can increase profitability for the company. So sometimes they just recombine already existing companies or reorganize them, and that's why we can say that it requires bigger investments. So many years ago, Borsodchem was acquired by venture capital fund in Hungary, and Borsodchem was already a huge chemical plant, so they had all these facilities to make some plastics. And what they have done, they purchased the company, and after that they were saying that okay, let's refocus the production process. So they started to make higher value added plastics used by automotive industry, and practically they built some new machines there, but the business process remained highly the same, so focusing on plastics. Okay, so angel investors are quite hard to find, so we will see later on in the when we're analyzing the companies that sometimes you can see investors with their names on their investment, but we can say that they are not, we cannot categorize them otherwise. So they are not founders, they are not related to the company, and also they are not representing any venture capital fund or something like this. So angel investors are always some former CEOs or some former managers who have huge or long experience on this specific industry, and also they have big enough capital to invest into company. But usually they are stepping in the early phase, and they can identify prosperous companies with bigger growth potential, and after that usually they are just used to utilize actually their networking capability, then their know-how, how to meet with other investors, and also how to reinforce corporate procedures. So sooner or later, even they can still stay inside the company as a strategic investor, but usually sooner or later they step down. But actually their knowledge is highly appreciated in this case. So traditional venture capital funds are way more important because they are organized around this job. So how you can focus on huge growth potential. So actually, if venture capital fund is, I will close the door just. Quite noisy outside. So yeah, traditional venture capitalists. So if we have to think about this, that when they are acquiring companies, they are always focusing on two-digit growth. So we are not talking about that. Oh, we can have a 5% of increase. No, they want to find something which expands and explodes rapidly. So that's why they need careful capital. They cannot be such a traditional investment fund that purchases shares, and if they are not able to meet their investment goals, then they have to sell them, and so they cannot be short term focused. So that's why they are always closed-end investment funds. So it means that they are collecting funds from their investors, like insurance companies, hedge funds, pension funds, and endowments, bank, and other individuals, wealthy individuals. But after that, they are using this money for a decade, at least. And once the decade ends, so 10 years later, they are selling all the assets acquired by this venture capital fund, and they are paying back the capital. But during the investment state, so during this 1 decade, you cannot exit from this fund. If you are able to find someone who will purchase your share in the venture capital fund, then you can do it, but otherwise you have to sit in this position. And that's why actually they can have long-term investments. So usually they have a focus of 5 years to focus on one company. If within 5 years they are not able to reach their growth milestones, then they are liquidating the enterprise and they are looking for other targets. So yeah. So as I mentioned already, it's not just about startups, because it's when we are talking about startups, it's always about venture capital, but also old companies, as I mentioned already. So recombination of the assets, reorganization, it's also highly important for them. And if we think about that, they have to have strategic involvement. So they are not just investors that, oh, here is the money, you can use it, and in this case up to the management have to reach profit. No, in this case they have high stakes in this company, so we can see that nearly half of the ownership, the shares are in their hand. And also they are defining milestones to reach for the company. So they have to have at least different growth levels, and if they are not able to reach these growth levels, so it can be market size, it can be at least you have to have some product which can be sold on the market, or some services which can be sold on the market. So moving from prototype or at least some prospect to prototype, and then some kind of product which is marketable already, and also then later on their market size can be an important stuff, and also they are delegating managers. So because maybe the company is funded by a good engineer or IT guy or something like this, what happened in the case of Silicon Valley series, but still you need professional managers, so still you need economists, still you need accountants, still you need HR, and so on, so you need a professional team of management. So that's why the added value of venture capital funding is that you will get this knowledge, they know the labor market in this region, and that's why they can do the headhunting, and they can add people to the management. Also, they are part of the product development procedure. So they can decide that, okay, but where to focus, how to place this product, who can be the potential target of this product. Also, they are providing legal services, so how can you optimize taxation procedure, how can you make your legal documents and other things. And also, it's really important that they are operating in a predefined region. So there is a region where many companies are concentrated around the Silicon Valley, because most of the venture capital funds are also located there. So if you are in the middle of nowhere in Minnesota or in Hungary, and there are no VC funds, then you have to relocate yourself if you need such support. And what happens with the exit? So if the company survives the next 5 years and they are able to reach the different milestones, and they have a product which can be sold on the market, and now it's expanding, so it's not just they are selling something, but they are doing it on bigger scale, so they are able to scale up, then they can sell the company on the stock market. It can be an IPO. And also an IPO is quite expensive. So in this case, you have to go to an investment bank. The investment bank have to make all the documentation. They have to make all the roadshow to amaze potential investors, and also they have to decide that how to do this, because sometimes you can ask the investment fund for a fee that they are purchasing some percentage of the shares to be sold on the market. They will do it with a discounted price, obviously, and after that they will sell it later on the market after the IPO was successful. In this case, you can reduce the risk of IPO failure, or you can sell it directly on the market, or it can be a Dutch auction when you are collecting the different offerings, and you can arrange them according to prices. So highest price offerers are served first, and then later lower and lower prices or bidders are served until you are running out of shares. So IPOs can arrange in different ways, but still there are huge fees for not just only to sell them on the market. And also after this, an IPO, or after an IPO, so if you are a public listed company after this step, then you have to meet way bigger legal requirements. So not just regular reporting, so quarterly reports must be published, and also annual reports, because annual reports must be also published by privately owned companies, but in this case the demand is much more detailed report what you have to publish there, and you have to be way more transparent, which can be good for the company, but also it requires way more work on it. And also communication is difficult, because if you remember Elon Musk's Twitter account and the scandals related to this several years ago, when he maybe was drunk or high or maybe just normal, but he was making jokes, and he was twittering that he will purchase all the shares of Tesla at $420 per share. At that time it was far from these price levels, and funding is secured, and then it was completely so the Securities Exchange Commission started an investigation because of insider trading, because it was questionable that it was a real news or real announcement or just made up, but it's coming from the CEO. So what can you do with this case? So we can result in nightmare. Just making some articles. Okay, so IPO, it's not just expensive at the beginning, but also to keep the company on the market and meet all the transparency requirements. And also, the Sarbanes-Oxley Act is also relevant for this case, because if the company is falsifying their books, or still we can say that if the information, financial data is not that real in their books, or later on you have to correct it somehow, then the managers can be sentenced to some prison time in the US. So that's why legal stuff can be also really important. So if there any questionable thing is happening at the company, then you have to spend a lot of money on lawyers. So it also makes it expensive. So it can happen many times that the company is sold to another investor. So in the early 2000s, I remember that everybody was thinking about that, okay, the company should be sold on IPO immediately once they are in the growing stage. Later on, it was, at least in the IT sector, that let's look for potential investors, so let's sell it to Google, let's sell it to Microsoft, so let's sell it to some already existing big company who will purchase this and will be added to their portfolio. And we can see that Google was happily acquiring everything which was put into their face, and that was the time when they had this Google Labs and they acquired many different projects, and later on during the 2010s they started to close them down one by one when they realized that maybe these products were really nice, just they were not earning a dime on this, and that's why they had to close them down. And obviously the third point is when the company is closed because the story was not a success, and assets are sold on the market. So this is the liquidation case when you can see that maybe the individual assets are still worth enough, or maybe the IP, intellectual property rights, are worth a lot, but otherwise it's, they are not able to make further added value with their products, so they're not expanding enough, or maybe they have some buyers for their products, just it's not a growing market, it's a stagnating market, so they are useless. So SPACs. Here we can see that in 2021 that was the golden age. So in the last several months, so actually in February there were some articles that maybe the golden age of SPAC is over, but still we can see that okay, huge amount of money is invested through this way, and we can see that mostly in pharmaceutical or technology sectors preferred. So what is this special purpose acquisition company? It's a way how you can sell or introduce a company on the public market. So it's not like IPO, or it's a special way of doing the IPO, because in this case you have the company already. So this is a private company, it works well-ish, and they need some money. So instead of just introducing it to the market, you are creating a company which is already a public company, and this will be this SPAC. And this public company collects its funds mostly from the directors of this SPAC company, so around 20% is collected from there. The rest is sold to the shareholders, and after that, once they collected this capital, then they have 2 years to identify potential acquisition targets. So it's like a half IPO, half merger and acquisition, because we can say that they are looking for some company which can be useful to acquire, but after that, so it doesn't have any identity. So it's just was created completely to have something, to make it publicly listed, and to have shares in it. And that's why we can see that they have a warrant on it. So sooner or later they have an option to buy further shares if it's necessary, and we can see that half or 1/3 can be used in this case. And if the acquisition requires further funds, then they can issue debt, so they can issue bonds, or they can issue further shares, and even they can collect private investment funds. so private investment sources, and this is how they can collect the money. So it's maybe more potential. So literature says that there are some advantages. So in the PVC website, if you are checking these links, you can see that yeah, so it provides access to capital easier, and even if the market is volatile, or if liquidity can be limited, because already the money which is required for this acquisition is there inside the company. However, in this February, a SPAC failed miserably, because in the case of warrant, you have the chance to acquire or to invest further money. And what happened, that the SPAC was already funded, it was there, but once they were asking their investors to execute the warrant, so purchase further shares, the money was not arriving, and yeah, they were not able to do the acquisition. So maybe shareholders were not completely happy about the idea to purchase the target company. And it can lower transaction fees, because in this case you don't need extensive roadshows. In this case you don't need to pay the fees of investment banks. You don't have to run auctions and so on. So that's why it can lower transaction fees, and also can speed up the timeline of the listing procedure. However, still, accounting, financial reporting, registration requirements are there, so the company have to be prepared for to be publicly listed, and actually they have to do it fast. So you have some or only several months, so it's within 3 or 4 months you have to make the company ready, which means that the target company should be already ready, at least in their business procedures, in their reporting structure and so on, to make this happen, because otherwise it would be really hard or close to impossible to change or implement everything. And also we can see that nowadays, at least to be fancy, and mostly it seems to be now that it will be kind of part of a regulation, that you should have not just this financial reporting, but also non-financial reporting must be way more adequate, and it must be ready to have this environmental, social, governmental, so ESG requirements, and categorization must be added to the report, or your reports must be ready to provide all the data for this ESG ranking. And yeah, it takes also some money for the company to have these ratings, because nowadays still it's highly not defined that how this ESG can be rated properly. So there are different attempts, there are different service providers, but there are no perfectly made standards for ESG rating. But there are many investment funds which are already preferring ESG rated companies as investment targets, so that's why you have to do this. So there is an additional layer of costs of reporting, so not just providing fancy numbers, but you have to type in also text. So how SPAC is happening? So we can say that SPAC is created, they are IPOing themselves or itself on the market to make it already publicly listed. Then they are looking for targets, negotiating, if they are able to achieve some agreement, and the shareholders of the SPAC are also happy with that, then they will approve it, and this will be merger, and after that the SPAC will lose its entity and they will become the new company. So when Rocket Lab was acquired, or sorry, publicly listed through a SPAC agreement, now we cannot find the original spec. So it's called Rocket Lab Incorporated and it's listed on the stock market, but they were going through these phases. If they are not able to reach an agreement, then they are continuing the target search, or if it's not successful, then they can give back the initial investments to the investors and close down the operations. So we can see that at the beginning they are looking for the target, but after that it has to be speed up. However, we can see that most of the companies are not publicly listed. So if you are looking on the US, the National Bureau of Economic Research had this recent paper which describes that only some percent of the companies, even in the US, are publicly listed. So most of them are private, and they are absolutely happy to be private because, okay, listing has many pros. So you can see here 3 lines of words. So you have the ability to raise funds, the ability to use stock as a merger currency, which can be nice because in this case you can exchange your own shares with the target company. You don't have to take up a loan for acquisition, or you don't have to use up your precious currency reserves or cash reserves. So you can use stock as a merger currency. Liquidity benefits for shareholders, because if you are a shareholder, you can sell your shares anytime if there is the company is liquid enough. If it's a small cap company, then still it can happen that you try to sell your shares, just there is no demand for it. But if you are a shareholder in a private company, then it's way harder because there is no platform for this. So if you find someone who would like to purchase your share, then you can sell it happily, but otherwise it's way harder. Information about the firm gathered by public markets, and usually big companies prefer to have this because for them, so we can see way more big companies which are listed on markets, so they are overrepresented among public listed enterprises. Of course, there are problems also, so disclosure requirements, greater attention paid to the firm and management to avoid scandals in bookkeeping, transparency, or in communication or behavior. And there are fixed and variable costs of listing, which I mentioned already so many times. And what can be useful for large companies? So why is beneficial for them? Because if you are privately, or if you are a private company not publicly listed, then for you it's way harder to issue shares or to sell the new shares on the market, because you have to look for some people or some investors, and maybe you can efficient in this case if you have good enough track record. So if these investors can see that there are already some investors in this company, so they will bring their friends. But otherwise, you can have this problem that most of you will use debt financing because it's easily available. You can go to a bank and then you can have this. But if you are doing this, then your leverage can be quite high. So if companies start something like this, they have this equity, and once they are growing, they are always growing from the debt, then it can create huge leverage. And maybe some bank will say that, oh my God, you have so indebted, and what is happening that you are just increasing your assets only from using debt, and you are not indebted highly, just, yeah, this is what kind of source you use. Investors are more willing to fund tangible goods, also tangible assets. So it can happen that if you are a big company and you have tangible assets like buildings, machines, stuff like this, which can be touchable, then you are way more targeted on the stock market, because valuation is simple, easy, and we can do this. But if you are focusing on intangible assets, so you are providing services, not goods, not in the manufacturing sector, but let's say you have a hairdresser company, or in the book it was the example, it was like lawyer or law firm. Then if you have high amount of intangible, it means that most of the profit is generated because of your people who are working there. So if you are starting to fire them, or if they are leaving the company because they are not satisfied, then you are losing these intangible assets, or there is the potential of losing it. So intangible assets are only useful for public listed companies if they are well defined intellectual property rights or other intangibles. So if you have different patents, then it's a good thing. So what we were able to see last time when we valued in the Ariane space or Ariane group was that actually the anti-evaluation was derailed by the huge amount of intangibles. So we were able to see that I was running again the anti-evaluation procedure by the default scenario before I did anything with the company. So the original company, without any modification, it was around 4,090 euros per share. And once I was able to modify the operations with my stupid rocket, and I was able to conduct all this reusable first stage and so on, it was just increasing to 4,770 euros. So only I was able to increase the value by 700, because most of the value was coming from the intangible assets. And in this case, we have to think that, okay, but what is there? And we know that, or at least I know that Ariane Space is highly a leading developer on the field of 3D printing. So the first metallic 3D printer was developed by them. And so how can you 3D print titanium, aluminum, and so on? And they have many of these IP rights. Also, ESA was developing many stuff like this, and since then it's used everywhere on the globe. But in this case, if you can well define it, then it will increase corporate value. But if we can just see what happened with us last time, that we were looking on it, that okay, we should add it because it seems to be a significant asset, but otherwise we don't know anything about this, then maybe a real investor will say that okay, let's give a discount to it, or I don't want to invest in this company. Warren Buffett said always that he invests only in companies what he understands. So he did not care about IT or companies in the IT sector or the IT business in the 90s, because he was not able to understand their operations, how they are making profit. So he's focusing on simple stuff, what he can understand. And this is the case when, if you have a lot of intangibles, then okay, but how can we price them? And of course, if you are talking about intangible assets in the non-financial report, then you can collect some nice investors' money. So mostly what we can see on the market, manufacturing companies. So companies from manufacturing sectors who need funding to scale up their operations. Because manufacturing, or for example banking, are highly dependent on economics of scale. So if they are not able to grow fast enough, then all their fixed costs are fixed cost per product ratio will be too high, and they are not able to have they are not able to cut their prices, and they will lose their competitiveness. So that's why they will go to default anyway. Okay, and in many cases we can say that market capitalization of a firm is mentioned in many cases, but actually we can say that market capitalization are always related to the cash flows, present value of the cash flows, what we were able to see last time. That if you have cash flow growth potential, then you can value it in, and it will increase the value. And of course, we can have this equation as well. So equity share of the company, value added by a firm can be computed that we are taking all the outputs minus input materials minus labor, and then we have something which is can be considered as added value. But I think that focusing on cash flows and how they are generated, they can be more efficient. But if you are thinking about EBIT, already captures something like this, or EBITDA capturing this. So if you are looking on the value added as a percentage of the US nominal GDP, we can see that this bluish line is just the entire industrial firms to GDP, so this is the entire set. And if we are focusing on public firms, we can see that they have higher value. So it's not just a myth that, okay, if you are a big company and you are working in the industry, then if you are listed on the stock market, then you have to be more competitive. But in practice, we can see that they are way more productive than the entire sample. And if you are looking on the corporate data or the sectoral data, we can see that services, retail trade are really important, at least in the all firm sector. But if we are looking on publicly listed enterprises, we can see that mining, obviously you have a mine, you have equipment there, you have rights, so it's highly concrete. But you have here, and also manufacturing, what I mentioned already, and also finance is so in all cases, and also transportation is a bit more preferred. So we can see that these sectors have these properties that I mentioned already. Okay, seeding capital is highly different what we learned already. So it's like a strange combination of subsidies, government subsidies, and or any kind of subsidy, and also venture capital investments. So what happens here that you get technology transfer. So because in the case of the different NASA projects, so the commercial orbital transportation services, so COTS process, or when they were developing crew launch vehicles, the CC Dev project, what happened that they were saying that NASA will guide you, so they will support your ideas. First you have to have some concept for the vehicle, already you had to have some tests, so you had to have some engineers, some procedures, some software, some hardware, and so on. So not just that I have a great idea, please support me, NASA, but to make this vehicle concepts a reality and a working operational reality, which is reliable at the same time, at some levels, then you need technology transfer. So in this case, for example, they helped SpaceX to improve their shields, heat shielding, and they implemented some more fancier heat shielding than it was used before even by NASA in the space shuttles, because since then they realized that how can you make stuff lighter and more durable. Also, they can help you. You can use their testing facilities. Also, you can utilize or you can lease some launch pads. So they provided different level of technology transfers, but also in this case they are defining different rounds. So first there is always a tender, public tender, that okay, if you have a concept for some problem, so in this case it's you have concept for an orbital launch vehicle, then you can apply. And they are reviewing the different concepts. Or when last time they were doing this with the human lander mission, so they were requesting different offerings from companies, and there was the concept, landing concept from lander concept from SpaceX. There was another group of companies, Blue Origin and Boeing, Lockheed Martin, and so on. So there was another group of companies, and there were also the third one, Draper Space. And okay, if you are selected, then you get some money. But in this case, the first round is always about some 10 million US dollars. So it's just make it more elaborated. And once they are reaching the milestone that, or the timeline, they are reaching the point when they have to submit their proposal, then there is a next turn for the evaluation. And what happened in the case of the human lander system, that NASA said that okay, the case of the Draper's offer, there was negative mass. So actually the vehicle was way more heavy than it's supposed to be to move around anywhere. It was just falling to the moon and never coming back. So it's one way of landing humans, but yeah, it's not the most efficient way. So they were kicked out from the contest. And this procedure goes on through different funding rounds, and usually the money is increasing. So in the second round, during the COTS or the CRS contracts, there were negotiations about several hundred million US dollars, and once you get the contract, then you are stepping in the billion stage. And also, we can see that the initial seeding capital program, it was necessary to have at least such a funding capability as the NASA provides. So it was not a complete subsidizing, because it would be 90 to 10% or something like this. The first time when I was introducing the entire topic, I was talking about that the European Space Agency has also some kind of seeding capital project right now, and we were able to see that okay, they were supporting the development of the Prometheus engine. But still we were able to see that majority of the money was coming from the ESA, and we were able to see some kind of industrial investment, but it was not 50-50, it was much more like 70 to 30%. So so that's why it was way more aggressive. And in the initial cost competition, there were only two companies. So there was SpaceX and there was Kessler Technologies or something like this, but they were not able to raise the same amount of money to meet the NASA's requirement. So they were not failing because of technological reason or because of engineering stuff. They were failing because they were not able to collect enough private equity or enough private capital to fund their own company. So they were kicked from the competition or removed, and after that orbital sciences were added later they were merging with with ATK, and after that they were acquired by Northrop Grumman. So it's also a strange story, but we can see that in this case, NASA wanted to have risk-taking, or they were mentioning much more risk-sharing between private investors, but they wanted costs, and it was a high motivator for the private investors to cut their costs if they are risking their own investment in it. And after that we can see that it was efficient, because at least we had one company which was focusing on reusability, and after that they were able to build up this scheme or this business model when the NASA doesn't care about the technology anymore. They don't own the launch vehicle, they're just paying for services, because they are saying that, come on, low Earth orbit is really close to the ground, so after half a century then it would be obvious to be served by private companies, and we can see that at some levels it works already, and yeah. The problem is that only SpaceX meets to these requirements, because Sierra Nevada is always in the game, but their shuttle, they have a small space shuttle-like thing, which would carry only cargo, and it always flies in the next year. I started this research in 2016, in autumn of 2016, and this space shuttle-like thing, it's always flying in the next year, since 2016. So there is one slight hiccup, or Boeing Starliner, which is not able to provide services in the last 2 years now. They are still waiting for the first successful launch, which is not ending with a disaster like the first one. So yeah, they should at least reach International Space Station. So we can say that they did something, just is highly asymmetric, and it always SpaceX which delivers at the end of the day, which is a good thing, just they were hoping for way bigger competition, which is not appearing yet. Okay, so sovereign wealth funds, so state-owned investment funds. They are quite tricky, because we can say that they are behaving like an investment fund, so they are also rational investors who are looking for profit. And they are always, so their investment strategy is guided by the Ministry of Finance, so they are not behaving like foreign exchange reserve, because foreign exchange reserves are always managed by central banks. Sovereign wealth funds are always guided by the Ministry of Finance, so it's like a fiscal entity, but it's put far away from the fiscal entity. So if they are profitable, then their revenues can go to the budget, as like taxes, just like profit of state-owned enterprise. They are behaving like this, but the investment strategy is defined by the government. So there is a law. In Russia, when they created their sovereign wealth funds in the mid-2000s, since then these investment funds are closed down, because the last money was spent in the middle of 2010, so around the annex of the Crimean Peninsula. But in their case, for example, the investment strategy of the reserve fund or the national wealth fund was defined by law. So there was a law about the investment, and a decree by the Ministry of Finance. And after that, they were saying that what kind of bonds can be acquired. So they were really precise, because they were saying that only AAA or AA rated euro or US dollar or British pounds denominated bonds can be purchased, and also even the maturity of these bonds were defined. But also we can see that other sovereign wealth funds can be way more flexible. So in many cases we can say that they are asking private investment funds, private investment banks to provide portfolio management services for them. So it's like they are going to Morgan Stanley or Goldman Sachs or to other investment bank that, okay, here is this amount of money, please make more from this. And we can find different strategies, so because their funding is quite stable. So the first SVF was created in Kuwait in 1953, and mostly what they was looking for, that they wanted to invest their oil export revenues, because you can tax oil extraction, or you can put customs on oil export, or maybe you are investing or reinvesting the profit of the national oil company. It doesn't matter, so somehow you can raise money of this. Or, for example, in the case of China, their SVFs are filled up with money after or due to the fixed exchange rate regime of the Chinese renminbi, because Chinese yuan should appreciate always, but it follows some fixed regime, and they have this huge external trade surplus, which push, or at least would push the renminbi for appreciation. So they are constantly intervening to avoid this appreciation, and it creates excessive US dollars and euros in the hand of the foreign exchange reserves. So a majority of this foreign exchange reserves was reorganized and organized as, at least they have 5 or 6 different sovereign wealth funds nowadays, and you have to invest it somehow. So you cannot invest this money in the domestic market, because it have to be still in hard currencies or in key currencies, and also it would completely bias the domestic market if you would let this liquidity to flow in. So it's much more reliable to invest it abroad, and that's why this money is. I cannot say that this money is invested in as a diversified portfolio. So they are way more conservative than a diversified portfolio would suggest. So they are keeping way more bonds than shares in their portfolio, and also they are not wiser than private investors usually. So it was quite scandalous that SVFs purchased shares in investment banks before 2008 banking crisis. So Lehman Brothers and other banks which went later on default or nearly to default were able to sell shares to SVFs, which were after that losing their investments or some percentage of their investments, because these banks went to default during the crisis. So yeah, they can have also bad acquisitions. And if you are looking on the market, actually we can see 2 companies which are using SVF funding. So Virgin Galactic and Virgin Orbit is owned mainly by, or one of the majority shareholders is the one of the SVF owned by Abu Dhabi, and I remember that this acquisition was about 100 million US dollars, and after the company was IPO'd on the stock market, they regularly were increasing or decreasing their share and exposure to it. I think that it was not the brightest idea. So Virgin Galactic is always like the euro introduction or adoption in Hungary. So it's always happening in the next year when they launch people on. It's not even orbital launch platforms. It's just suborbital launch. It's for space tourism, and they were flying now once with some people, but I remember I was a university student when the first time I was reading about them, that they want to do this, and still it's now 2022 and still not flying. So later on we will check their share prices and we will see that it's dead cow state. Virgin Orbit, which was at the beginning it was part of the Virgin Galactic, then later on they separated it because it's just focusing on launching satellites, small sats. And they have a huge cargo plane, and they're launching this rocket from this cargo plane, and in this case they don't have to build first stages for their rocket. And maybe they have now 3 launches. First launch was exploded, obviously, but at least 3 successful launches happened since then, so at least they are operating on the market, and we can see that this Abu Dhabi SVF has quite important funding in this company. So what is quite strange here, that if you are looking on the structure of who owns Virgin Galactic, we can see here OMV, which is an oil company, but for some reasons they purchased shares in it. Okay, if you are focusing on other companies, then this is Rocket Lab. So Rocket Lab is way older. So Peter Beck is start to build his first rocket engines on and put it on motorbikes. So if you are checking videos on YouTube, you can see that one crazy guy sits on a motor and it's propelled by a rocket engine. This is how he started, and he's not a US citizen, or maybe now he's a US citizen, but originally he is coming from New Zealand, and launches are happening also from New Zealand because it's way easier to launch everything there. There is no air so you have to still close the airspace, but usually no planes are flying there, or you can close down the sea where the stages are falling because mostly there is nothing there. So it's less crowded like Florida, and he was able to build up his small sat launch company quite carefully, and he's a really nice guy. I like the interviews with him because he's less superstar like Elon Musk, but still he's quite an interesting guy. In the past, he was saying that he will eat his own hat if they are focusing on reusability, or if he want to build bigger rockets than his small sat launches. So last year he was eating his hat in front of camera. You can check it also on YouTube, because he announced that they want to recover the first stage of their rocket, and they were doing it by catching it with a helicopter, and they were able to recover some of their vehicles by using parachutes, but they don't want to let it fall into the salty seawater, so catching with the helicopter part was still not happened yet, so it will be interesting to see when it happens. And now they are over 20 launches, so I think it's 22. Last week they launched also small sats, so it's satellites like this size, and they can launch some of them. And they exploded only 2 launch vehicles. And design is quite simple, because they are propelling the entire engine with electric motors and using batteries, because in this case they can make everything more simple. And also the main feature of this company, they are using carbon composites, and they are the only one on the market which uses carbon composites, and they are highly specialized in this field. So yeah, and if you are looking on the structure of the ownership, we can still see that Peter Beck, as the founder, still owns quite nice share package. But also we can see here that this is an investment advisory firm, so it's a portfolio manager. They are managing funds for pension funds and other entities. This one is a venture capital investor, this one is another venture capital investor. This one is a financial vehicle, it's sounds ridiculous, but it's also an asset manager, just a strange name. Also, we can see private equity firms. This one. So this one and this one as well. So they are also keeping Rocket Lab as part of their portfolio, but obviously under 10% you don't have strategic influence on the company, so you are not able to delegate managers to the board, so you don't have strategic influence, just you are really happy if the share prices are going up. And I mentioned already that sometimes we can see business angels, so there is this guy, Matthew Oko, and if you are checking on his website, you can see that he's supposed to be at least identified as a business angel because he's not part of the management of the company. And also he was CEO at different tech companies in the past, and now he's investing his funds into different tech companies like Rocket Lab. So behaves way more like a business angel, not a founder or other categories. So we can see that if you are looking on private equity firms, then they are managing funds for corporate pension plans, sovereign wealth funds, in university endowments, family offices, and so on, foundations. And also we can see for this one, they are focusing on the same thing. But here we can see one investor from the industry. So Lockheed Martin has 1% of shares. And at the beginning, everybody was thinking that there will be some nice technology transfers between Lockheed Martin and Rocket Lab, but I was not able to dig up anything which is related to this thing. So maybe they just completely financial investors, or we don't see it. Maybe something is happening, just it's not visible for us from outside. And now let's see the big one. I spent at least 1 hour to build up this. Because SpaceX is a private company, and Musk wants to keep it this way. Right now we know that there are actually 3 different business territories or business segments. One is about the orbital launch capability to use Falcon 9 and all the rockets and the vehicle, Dragon capsule, to launch stuff into the International Space Station or people if they want to pay for it. But also they are developing Starship, which will be on a completely different scale. So compared to Falcon 9 can launch 10 tons of cargo, and that's all, if you want to be an economic scale. Starship would do the same thing just for 100 tons, so it's big, and but it's under development. So if they are lucky and if they are able to solve all the stuff which is related to Starship, we are already through some fancy explosions, but now right now we are waiting for their first orbital launch. It will be success if it not explodes on the launch pad. If the first stage is able to deliver the second stage on into space, and if the second stage is not disintegrating once it's coming back to the atmosphere, then it will be a success story. So, but right now it's in the development, so they are in a second expansionary state. And the third thing is Starlink, providing satellite internet at low Earth orbit for $200 and it's broadband internet and low latency internet, and already they have several, I don't want to say stupid things, so 1,500 satellites are already there. Just sometimes satellites are coming back, or last time, several weeks ago, they launched 50-something of such satellites, but the sun was highly active and they were falling back into the atmosphere and burned because the Earth's atmosphere was expanding and they were not able to ignite their engines early enough, so it was a sad story. But how can you get funding if you are a private company? And Musk was saying that maybe Starlink will be IPO'd in the future, so maybe introduced on the stock market and make it public, but he can't think that SpaceX could operate as a public company because they are way more risky to list it on the stock market. And therefore I'm sad because I don't want to purchase other small launcher companies. I would like to be shareholders in this one, but obviously they are way more happy to collect money. So let's see how they did this. So if you are looking on investments, we can see that, okay, at the first round, when Musk was investing his own for 100 millions, and also NASA was seeding it with also an additional for 100 million US dollars. It was enough only to build 4 Falcon 1 rockets and let 3 of them explode and 1 to deliver cargo, and to get further NASA funding. And after that, we can see here that once they get the contract from the NASA, after the last Falcon 1 was not exploding and was able to deliver cargo, that immediately there were additional investors appeared. So there is this Founders Fund LLC, which provided small amount of capital. So we can see that 20 million US dollars and in convertible preferred stock. So we can see that it's highly defensive investment because you can convert this stock to bonds. So even if the case of default happens, then you can step forward as in the liquidation step, so you can get earlier money than ordinary stockholders. And it's a preferred stock, so anyway you can get some payments. Then 1 year later, they were able to get some additional funding. You can see that now venture capital investors are appearing around it. And it's funny because in 1 year there is this Draper Fisher, so we can see that maybe they were able to reach several milestones. This procedure is completely untransparent for us, so we can just assume that, okay, there was the first round, second round, third round, fourth round, fifth round, and we can see that this is gradually increasing. Also, there were some undisclosed venture capital investors. We don't know who, but they were happily investing their money. And also we can see that they started to deliver to the International Space Station actually in 2012. So before that it was much more like prototypes were flying, or so they were still in a developing stage. At this point we can say that they proved themselves. So now they are a valid company. And in 2015 they started to test reusability at this year. So they need additional funding because, okay, the single-use launch vehicles were already a product, but still they needed further funding to finance the analysis of reusability and how you can do this. And it was disastrous in the first 2 years, so mostly everything was exploded until they were able to land finally in 2016. And you can see that Founders Fund returned and also invested some money. Still, convertible preferred stock was on their menu. And also we can see that the same amount of money was invested by all these investors. So they are still conservative. There was some big whale here because some undisclosed firm invested nearly $1 billion US in convertible preferred stocks. And after that we can see that the scale of funding dramatically increased. Okay, there is a cute one because Vantage Capital invested $5 million US, while all the others are in several hundreds. were invested, but still we can see that venture capital equity or preferred shares or sometimes common stocks are here, but mostly preferred shares are still popular among the investors. And this is my favorite one. So Ontario Teachers Pension Plan Board. So it's a pension fund from Canada and they are purchasing SPAC shares on the private market. So yeah. And after that we can see that the development of Starship required further funds. So we can see that this money is flowing highly into this kind of development, because they went down to Boca Chica in Texas, and from nothing, so literally on a swamp, they built up a huge test facility, a production facility. They had to develop the entire Raptor engine line. Also, they had to test, so blow up some vehicles. There also they were building up their experimental launch pad, which is supposed to work now, just we are waiting for FAA license, which was at the first time they were assuming that, or FAA said that they will provide the permission or rejection until late February, but still it's waiting for it. Maybe at the end of March they will be able to give this. So we can see that in last year they were able to collect enormous amount of VC equity and other preferred stocks. So, and also we can find, or I was able to find some loans also to SpaceX. So we can see here that in many cases banks prefer to lend, not a loan. So it's called, I forget even the Hungarian word for it. It starts with a C. Okay, so they are standing together and not alone. So in this case, they can reduce or diversify the risk of non-performing loan. And here we can see that the amount of money is quite high, and we can see the timeline that in the early phases when VC capital started to flow in small quantities, already they were able to acquire some loan and some funds. So actually my original debate, maybe I was right, because I was started to deal with this topic of SpaceX and that commercial launch business, because on the debate I was telling that, oh, they can do it only because interest rates are really low, and that's why they can get funding for their operations. And people were saying that, oh, they are funded only by or through seeding capital or through venture capital funds. And at the end of the day, we can see that also they got traditional commercial bank money as well.